What's up, Squares? Harold Perkins here, and did you know that you can buy a real estate investment property even if you don't have a job or any kind of verifiable income? Yeah, that's right. Today I'm going to talk to you about how to buy a rental property with a DSCR loan. DSCR stands for Debt Service Coverage Ratio. This is a great option for anyone looking to invest in real estate and generate passive income. A DSCR loan is a type of mortgage that looks at the rental income of the property to determine whether or not you can qualify for the loan. Instead of looking at your personal income, we look at the cash flow of the rental property to make sure it can cover the mortgage payments. So the mortgage, the taxes, and the insurance are the debt to be serviced. That's the DS part.
Give me a D! D!
Give me an S! S!
The rental income is the coverage, or the C.
C?
One C.
And the ratio is the percentage of the rent to the mortgage payment, so DSCR. In order to qualify for a DSCR loan, you have to have a credit score that's at least 620 in most cases. But that's if you're somebody that has experience owning and managing rental properties, then the 620 score is allowed. But what if you're using this loan to purchase your first investment property? Then a minimum credit score of 660 is required, but that's not so bad. But what if you've never owned a home before and you're using this loan to buy a house for the first time? First, what are you doing? That's weird. Just kidding. While it is more common for somebody to live in the first home that they purchase, there are scenarios where it might make more sense to be the renter in your primary residence and purchase an investment property. Your credit score in this case has to be at least 680. So back to the R part of DSCR.
R!
The property also needs to have a minimum ratio of 0.75. That means that the rental income only has to be 75% of the monthly mortgage payment. Noise. Okay, how do you calculate the DSCR ratio for a property? Simply divide the monthly rental income by the monthly mortgage payment. For example, if the property generates $3,000 in rental income per month, and the monthly mortgage payment is $2,500, then the ratio is 1.2. So is that a good DSCR ratio? Well, it depends. I mentioned earlier that the minimum ratio is 0.75, but the lower your DSCR ratio, then the higher your interest rate or your down payment will be. Yeah, that's right. So while a 0.75 ratio is acceptable, it would be better if the ratio were 1.0, even better at 1.2, and the best at 1.5 or higher. Well, that makes sense. The more rent that a property brings in makes it more likely that you'll be able to make the mortgage payment from that rent.
Where is the rent? I must have the rent. Dollars, dimes, and nickels, I need them all right now.
So you get rewarded in a higher DSCR ratio scenario with a lower interest rate or lower down payment requirement because there's less risk to the bank. Let's talk about the rental income for a bit. Let's say that you're purchasing a property that's already being used as a rental property by the current owner. Well, that makes it easy. There will be an existing rental agreement and documentation of what the current tenant has already been paying in rent. You calculate your ratio from that. But what if you're purchasing a house that's not currently being used as a rental? Well, then the appraiser becomes the most important person in the transaction. So we all know that the appraiser is the one that's going to determine the market value of the house. But did you know that the appraiser can also determine the market rent for the property? Yeah, that's right. As part of the appraisal report for the property, the appraiser will prepare a market rent analysis. We call that form a 1007. The appraiser will find similar properties in the area that are also being used as rental properties to determine what the market rent is. Then that becomes the number used to calculate the DSCR ratio. Well, that works great if the house is going to have a long-term lease of a year or more, but what if the house is going to be used for a short-term vacation rental like Airbnb or VRBO? I live in the Phoenix area, and the Super Bowl was just here last week. Very modest houses here in the area were renting for $20,000 for the week of Super Bowl.
The prices are going to be sky high, and that's if you can even find something.
Obviously, the Super Bowl is not here every week, so you cannot count on $20,000 a week in income for the house. In this situation, the appraiser would calculate a more average income for short-term rentals like Airbnb or VRBO. Then the underwriter would reduce that number another 20% to account for vacancies. But wait, there's more. As we all know, owning a house comes with other expenses. There's maintenance, there's repairs, management, and the advertising and marketing of the house when it's vacant. These are expenses that have to be considered when calculating the profitability of a property, or the DSCR ratio. So back to the appraiser. We'll also have the appraiser prepare an operating income statement to address those expenses, and we call that form 216. When the appraiser determines the operating expenses for the property, that number is subtracted from the market rent on the 1007, and now the final calculation of the DSCR ratio is done. The biggest benefit of the DSCR loan is that it allows you to qualify for a mortgage based on the rental income of the property rather than your personal income. Yeah, that's right. I talked about credit score, I talked about DSCR ratio, but that's it. That's all I talked about. Sometimes people have income that cannot be documented in the traditional way for a traditional mortgage. So maybe you're newly self-employed, or maybe not all of your income makes it to your tax returns. Or
What did you do for a living?
I was an amateur DJ, specializing in EDM, electronic dance music. I was also an amateur hip-hop backup dancer, an amateur body spray inventor. I did pranks on Vine.
None of those are jobs. What did you do to make money?
Oh, I sold fake drugs to college kids.
regardless of your source of income, the DSCR loan can be an option for you. This can make it easier to qualify for a loan and invest in real estate. Additionally, the rental income can help cover the mortgage payment, which generates passive income, which helps you build wealth over time. But wait, didn't I learn in mortgage broker school that back in 2008, the CFPB implemented an ability to repay rule? That rule requires creditors to make a reasonable, good faith determination of a consumer's ability to repay any consumer credit transaction secured by a dwelling. So doesn't that mean that a loan that does not document the income required to repay a mortgage would also violate the ability to repay rule? That's why there's no more stated income or no doc loans. Well, no, the DSCR loan is possible because there's an exclusion to the ability to repay rule for credit that's extended primarily for business or commercial use. If you are buying a house for the purpose of renting out to somebody else, then you are conducting a business transaction, and this is not for your personal use. Okay, that makes sense. The idea here is that people that are purchasing a home to live in should be afforded certain protections against predatory lending. People that are entering a business transaction should be savvy enough to do their own due diligence and therefore do not need the same protections that somebody buying a house for personal use would need.
That feels weird, but I'll allow it.
I'll allow it. Before buying a rental property with a DSCR loan, it's important to do your research and make sure the property has either a strong rental history or potential for generating rental income. You also need to make sure that you have a strong business plan for managing the property and covering any unexpected expenses. For example, you may want a larger deposit if you're renting to a bunch of college freshman art school kids, especially if the rental income is your only source of income. You could be in a bad spot if you don't have sufficient savings or reserves to rely on in the event the property goes vacant for an extended period of time, or if a major repair expense pops up.
I'm bathing it in this mixture. Using this I'm going to do that quite easily. A little bit of time. Talk about art and politics. I like using notes.
The last tip I'll give you about DSCR loans for today is about licensing. Remember earlier I talked about DSCR loans being exempt from the ability to repay rule because they're primarily used for business purposes. Well, similar leniency applies to loan originator licensing because it's a business use loan. There are 34 states in the US that do not require either your loan officer or the loan officer's company to be licensed to do a DSCR loan in that state. Yeah, that's right, it's legal, but do you want that? I think that a loan officer and his or her company that has taken the time and effort to be licensed in the state that they're doing business in is a better option for you. There's an inherent drive to perform with your best interests in mind when they've volunteered to be held accountable by your state's regulatory agencies. You can check company and individual licensing here. DSCR is awesome, and it fills a need for investment property financing for people who might not be able to own or manage investment properties otherwise. If you have any questions about DSCR loans or any other type of mortgage, message me or write me in the comments below. I'll answer your question like an underwriter, either approved or denied. Later, nerds.
Yeah, that's right.